Trading feels hard because it is hard. That is the first truth most people try to decorate with psychology, indicators, or a better platform. I do not buy that framing. The real problem is that trading compresses uncertainty, costs, and self-deception into one continuous test. You are not just guessing direction. You are paying spread, slippage, and time decay while trying to survive a market that changes its behavior faster than most traders change their opinions. That is why the job feels brutal. The feedback is noisy, the edge is fragile, and the punishment for being wrong arrives immediately. The average trader wants a clean story. Buy here, sell there, repeat. Markets do not reward clean stories. They reward asymmetry, patience, and the ability to tolerate looking wrong before being right. Most setups fail because the evidence behind them is weak, not because the trader lacked courage. A moving average crossover, a breakout, a support bounce, a macro narrative. None of these are edges by themselves. They are hypotheses. If the sample is small, the regime unstable, or the execution sloppy, the hypothesis collapses fast. That is what makes trading feel so difficult. The market does not care that your idea sounded reasonable. I think a lot of traders underestimate how much of the pain comes from variance, not incompetence. A decent strategy can lose money for a long stretch and still be valid. That is a hard sentence to live with, because humans are built to confuse short-term outcomes with truth. If you take 5 trades and 4 lose, your nervous system screams that the method is broken. Maybe it is. Maybe it is not. The only honest answer is that the evidence is still thin. Trading demands statistical thinking, but most people bring courtroom thinking. They want one decisive verdict. Markets offer a distribution, not a verdict. The second reason trading feels hard is that the costs are invisible until they compound. Every trade has friction. Every adjustment has a price. Every overreaction to a candle adds another layer of leakage. People obsess over entry quality and ignore the full path of the trade. That is a mistake. A strategy with a tiny edge can be destroyed by turnover, bad fills, and emotional interference. Even a good signal can become untradeable if the average win is too small relative to the cost of getting in and out. This is where many retail traders quietly bleed out. The chart looks elegant. The P&L does not. Then there is the psychological trap. And I think this one is overstated in a lazy way. It is not that traders are uniquely weak. It is that trading creates constant ambiguity, and ambiguity invites bad behavior. You can always justify one more trade. You can always widen a stop. You can always tell yourself, this time is different. That flexibility feels empowering until it becomes a liability. The market punishes narrative drift. If your rules are vague, your discipline will be fake. If your rules are rigid but untested, your discipline will be expensive. There is no free version of this game. What makes the whole process even uglier is regime change. A setup that worked in a trending market can fail in a choppy one. A mean reversion edge can get crushed when volatility expands. A macro trade can look brilliant until the market stops caring about the macro. This is the part most traders do not respect enough. Edges decay. They do not just fade slowly. They can vanish when liquidity shifts, participation changes, or everyone crowds the same idea. A durable edge is rare because it must survive not just being right, but being copied, crowded, and arbitraged. So, when trading feels hard, I do not hear a mystery. I hear a mismatch between expectation and structure. People expect certainty in a field that only offers probabilities. They expect consistency in a system built on changing conditions. They expect emotional comfort in an activity that monetizes discomfort. That mismatch is the source of most frustration. If you want trading to feel easier, you do not need more excitement. You need narrower claims, better evidence, and smaller ego. You need to stop asking, will this work? And start asking, under what conditions does this fail? And how quickly will I know? That is the real discipline. Not confidence, not hype, not a perfect setup. Discipline means treating every trade as a test with known failure modes. It means demanding enough evidence before risking size. It means accepting that a strategy can be good and still lose today. It means respecting downside risk more than upside fantasy. The traders who survive are not the ones who feel least pain. They are the ones who understand why the pain exists, what it costs, and when it is telling them the edge is gone. Trading feels hard because it is a business of controlled uncertainty. If you do not respect that, the market will teach it to you at full price.